The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we had another mixed to lower day in the grain and oilseed trade on Wednesday as we take a assessment of this market in general and watch different trade flows and what's going on with the supply picture, not only in the U.S., but around the world. Let's try and dissect some of this and try to make sense of it. Joining us here for a weekly conversation, Mike Zuzolo with Global Commodity Analytics. Mike, good to talk with you again this week. And I don't know if either one of us loves looking at some of this price action in the grains, but at least the temperatures are better in most of the country here to start the week, Mike.
You got to look at the optimistic, positive side when you go through this. It really does, as we talked about last week, I think, Jesse, feel a lot like last end of July, early August with the pressure in the market. You hit it on the nose with the supply mindset just building and building, and really the ignoring by the trade of any kind of positive demand news out there or even positive supply news. And I think this is where it goes back to the tariffs. And so what we sit at right now is another August going into the mid-month WASDE report where wheat is leading the market lower. Corn and bean yields are expected to jump more corn than soybeans, especially given the crop conditions report, firming up that 73% good to excellent in corn, taking a point off of soybeans. And so very similar to last week's trade, if you go back and listen to us last Wednesday and take out the Federal Reserve comments or whatever we had in there and talked about the beans trying to hold up against the corn and against the wheat, it feels exactly the same way. And I think it really does go back to these things that we're talking about.
Well, let's take a look at a couple of the positives from Wednesday's trade. Let's start with the wheat complex. We did see some green on the screen there, and as we've talked about many times, wheat can kind of be the catalyst for a lot of these things. So starting as we look at the SRW monthly chart, what are you seeing in the wheat trade here when we think about some of these supply-demand fundamentals here at home and around the world?
Well, the biggest question I have right now in the trade for the trade is if we're going to make new 5-year lows like we did on Wednesday's trade, why are you ignoring the fact that the world wheat ending stocks are 7.5% lower in the July 25 report versus the August 24 report? That's the biggest thing that I think sticks out in my mind. And when I started to see the wheat begin to go down again last week, I started to think about where is there similarity between what's happening in the wheat leading the corn lower, and yet the soybeans are trying to stand up other than that yield issue we just discussed, especially given the fact that the US dollar is about 8-9% lower than, or 5%, I should say, lower than where it was about a year ago. And especially given the fact that the Ukrainians year to date have harvested about 11.4 million tons of wheat as of the 6th of August versus about 19.4 a year ago. And so even when you talk about a bigger supply globally, that doesn't quite fit. And obviously for the beans to be standing up so well against the grains, the global supply doesn't fit at all. In fact, they should be the leader to the downside. And I think what this builds into my mind is that as we go into the August report, and the biggest problem the trade will have to do to deal with, to defend what they've done in the price action heading into that next week's report, is the fact that we have ignored the world stocks and have really looked at the U.S. stocks and almost not even looked at anything else but U.S. stocks. And when you frame it and when you look at it through the lens of the tariffs, especially given the fact that our tariffs are currently, U.S. tariffs overall, currently running around 9% as we head into the August 7th, August 8th deadline, where we see a bump. We're thinking that the essential tariff around across the board for U.S. is going to be around 15%. So I think the trade has decided, in other words, to move towards looking only at the U.S. crop for the most part and not the world crop because of the tariffs, even though, as I said, the demand side for both corn and wheat have been very, very strong. We're really starting to pick up on the wheat exports here in the last several weeks.
Well, let's talk about some of those global wheat prices just to go along with your sentiment here. And I mean, U.S. Gulf wheat price is cheap, cheap compared to other areas. And it's just an interesting dynamic, I think, to take a look at here. To your point, is the market seems to be focusing on U.S. wheat more so than the global picture here, I think, Mike.
Yeah, and this chart really shows what the soft red wheat futures has done to the cash market. It's not like soybeans, where the soybeans are hanging up in the futures market, but the basis out west in Nebraska, Kansas, South Dakota, hitting 70 under at this point for new crop beans, Jesse. And so the cash market gets it when it comes to the weakening of exports for soybeans. The futures market's trying to offset that and try and buy beans instead of the grains. And here we see in the Gulf price of 11.5% protein wheat, we're looking at a 210 per ton number. That takes us below the lows from August of last year, and it takes us to a new 5-year low at this point, the lowest since late 2020. And I think this really does add to the idea of what we've talked about pretty much all summer long, and we'll talk about probably more towards the end of the commentary and the conversation today about the energy markets and about the crude oil market. We saw the crude oil market get a lot of news on Monday, Tuesday, Wednesday. President Trump moving ahead with the jumping of tariffs on India from 25 to 50%. I think that was one of the key features that added to the weakness in the grains, because as we've talked about, we need India if we're not going to get China in terms of an agriculture related trade deal. But those 50% tariffs, 25% of that was specifically put on because India has been buying about 1.5 million barrels of Russian crude oil a day at this point. And so President Trump saying, I'm going to use my tariff policy as my economic and my foreign policy, and I'm going to punish you with higher tariffs if you keep buying this oil that helps fuel the Ukraine-Russia war. And so this is where I think crude oil and wheat really do play a big part, because all roads lead back to Russia. All roads lead back to the Russia-Ukraine conflict.
Well, and heading into that WASDE report for August next week, and just thinking about the stocks to use ratio and this idea, maybe are we carving out a demand low here, things like that. What are you going to be watching for the most heading into next week's reports?
Yeah, with us being about $25 a ton cheaper in the wheat right now globally in the cash market, and we're about $25 to $30 a ton cheaper in spot corn versus our biggest competitors right now. Again, the cheapest in the world. Argentina is maybe the closest to us at this stage. I'm going to be looking at this chart. I mean, this is what I think the trade is trying to price in, along with a much bigger corn yield for the United States. But if you look at this wheat market through the lens of the world numbers, you're at a 9-year low. And again, as I said, you got about a 237 million ton ending stocks number right now versus 256 back in August of last year. We're 7.5% lower than last year. We're at a 9-year low in the world ending stocks to use levels, which this chart shows. Once you factor in demand, why would you be trading 5-year lows when your stocks to use levels are at a 9-year low and your world stocks levels are at a 4 or 5-year low? And I think it goes back to the orange line. The U.S. ending stocks for wheat are at a 6-year high. You can see a similar trend in the wheat as you do in the corn, as you do in the soybeans. And so if you flip this chart upside down and had really high world stocks and relatively low U.S. stocks, that would be soybeans. And that helps explain to me what I'm going to be watching for in this report. And whether that 188 private yield estimate for corn that takes you up to almost a 2.3 billion bushel carryover, and that 53.5 bushel private estimate in soybeans, which takes you up to about a 400 million bushel ending stocks number, is that dialed in when we get the USDA numbers?
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk. Let's look at that corn market. You brought up the ideas of some of these private estimates that are out there, and the talk is we're going to have a big crop as long as we finish this thing out here in the month of August. And I know December corn on Wednesday broke below $4, did finish today closing slightly above it. That's an area I know a lot of folks have been watching here. But as you think about everything we talked about in the wheat side of the trade and segue to corn, what are you watching the most here over the next week or so?
The biggest thing I'm going to be watching, Jesse, is whether the wheat market can find a low after the report and therefore give us the ability with a weaker dollar and a firming crude oil market, because I'm assuming if the wheat makes a low, the crude oil is making a low as well. We don't need to go through that 360 low area in the corn that we hit last August. And that obviously involves the U.S. yield and the U.S. carryover. When September corn hit 375 on Wednesday for a low, that is dialing in my price model about a 2.3 billion bushel carryover. And I think you could see on Wednesday what we're talking about when it comes to when the wheat went back to positive, the corn was very quick to find short covering. I think, again, what I really want to be laser focused on here is not just the U.S. ending stocks of how close we are to 2.3 billion, but what the wheat does in price action, and then what the world ending stocks for corn is going to be, because I think the trades also started to build in the mindset that we have a lot bigger world ending stocks because of Ukraine. We've jumped back and forth on Ukraine at this point in this month as we enter that report time period.
Well, and thinking about the world supply and use, looking at this table ahead of the WASDE report next week, any thoughts as you look at some of these numbers and really drill down here, Mike?
Yeah, I mean, this is what I wanted to show you and the other viewers here as far as where we're at in terms of how skewed and off center we are when it comes to what the trade is looking at. If you look at that 24.25 number, and you look at the ending stocks at 311.6 million metric tons, that's what the USDA gave us last year in July. And this past July, that same number was 284.18. In other words, they cut that down from 311.6 a year ago down to 284.18. But then if you look at the 25-26 ending stocks number, USDA gave us last month 272. That's down almost 13% from what we had going into the August report last year. And the trade knows these numbers. That's why I like this table so much, is because heading into the August report last year, we had almost a 312 ending stocks number in the world. Can we take the ending stocks number up to the levels of 312 when it's sitting at 272 right now? And that to me is about the only reason why we would go through that 360 low from last August. And so that's kind of the metric I'm using, is it's going to be very difficult to add 40 million metric tons of ending stocks onto the 25-26 number to match up with where we were last year at this time, when we are essentially at the same price.
And I know weather, again, so much talk about the U.S. weather and how things are looking for corn, but what about in Ukraine? We haven't talked about it a lot as we continue to watch things over there. We've touched on it with wheat, but what about corn, Mike?
Yeah, good point. And you and I have been talking a lot about the Black Sea this year, but we really haven't hit the corn as hard in the last couple of weeks. And I got a real surprise by an attaché report that came out Monday, and it helps explain, I think, why, if the Black Sea expectations are building, the wheat leads the corn lower, because the grains are the grains. And what that attaché report said was, well, I know I'm looking at this subsurface soil moisture map as of 7/15, but at the time of the writing of this, and you can see it in the top, the subsurface moisture is developing, deficit was developing all across Ukraine. And we could downgrade this corn yield forecast should it continue, but we're going to go ahead and bump it up because the Ukrainian ag minister added planted acres, they added yield. And so what essentially happened was the attaché report took the production number that we currently have of 30.5 million metric tons up to 34.7. And then they took the corn exports for this year from 24 to 28.5. And I think that did a lot to hurt the reputation of the tight corn narrative globally that we have. And that just happened, as I said, on Monday. And that yield number that gets us up to 34.7, puts you right up against the record yield levels of 7.7 tons per hectare. And so I have looked at these maps every which way I can, Jesse. I just can't see near record yields in Ukraine at this point.
Let's segue over and talk livestock. Cattle futures, another positive close on Wednesday. I was a little worried, a little skeptical early Wednesday morning as we were kind of mixed to lower in cattle, but we saw a nice rally back. We continue to be at or near record highs. I mean, what stands out to you the most here as you look at the resiliency of this cattle market, especially after last Thursday, where I think a lot of folks got nervous with the big drop we had?
Yeah, that was a big risk-off day, and it seemed like it was all over almost all asset classes, and that was a one-off, so that was nice to see. I forgot to label this. The white line is the negotiated cash price sitting up around 241.88 on the last and midday Wednesday versus that August futures price of around 236.40. I think this is the heart and soul of the market right here, is with August going off the board at the end of the month, having a $10 to $12 premium in the cash market coming into this week. We didn't need a lot of good news. We just didn't want any bad news, because that discount in the futures, at some point, those two need to come together, since fat cattle, unlike feeders, are still physically settled. They're not a cash index. The fats are not a cash index. So what happened, I think, on Tuesday was we saw that the Brazilian tariff relationship and the U.S.-Brazilian comments going back and forth were not very good, especially given the former president of Brazil being put under house arrest. And then we saw today, I think, the June beef imports come in. USDA reported them down 20% for June versus May. That supports the idea that we had late last week that Brazil was going to stop sending as much beef to us because of these higher tariff threats. That seems to be working into the numbers now at this point as of June's data. So I think that underpinned us, along with, to my surprise to some degree, McDonald's earnings. The global same-store sales came in up almost 4%, beating analysts' estimate by a long shot. And then we had Yum Brands come out, KFC, Pizza Hut, and they're still looking to expand dramatically in the global stores that they're going to start building this year. They're not backing down at all. So that fear about the consumption side of the equation, I think, is abating right now because of some of this high frequency anecdotal news that we're getting through some of these earnings.
And that's interesting. You know, Tyson had their earnings out. They said a boom in chicken is going to offset losses on the beef side here this week. But to your point, I can't get a complete read on the consumer side of this picture for meat at retail, and if they're starting to push back on high beef prices or not, Mike. I just can't get a read on it.
Yeah, I think pork and poultry are winning at the grocery store, but I think at the fast food, it's a mixture. I think it's the sit-down restaurants and the smaller chains and the smaller, sit-down high service restaurants that are going to be probably the most vulnerable. But the Tyson numbers really were due to the price going up 10% in beef. And so it was natural to see that 1.5% decline in volume because of that 10% increase, when I think pork actually went down a little bit in that same earnings report.
You mentioned energies earlier in the show, and I do want to ask you about that. We got one more chart to take a look at, a distillates chart, and thinking about crude oil prices, diesel fuel needs, things like that. Anything you're tracking here, Mike?
The past couple of days, we started to see the distillate prices go up, and at the board, at the Mercantile Exchange, at the NYMEX, and I started to keep track of that as I started to see prices escalate. And when I got the weekly stocks data from the Department of Energy on Wednesdays, like we get every Wednesday morning, I noticed that we came off of a record low in distillate inventories, and we're still near the lower end of the range for the last 3 years when it comes to the Midwest retail diesel prices. And you see in this chart not only the record low, because you can't see anything past 2020, but on the same video feed tonight, I'm going to be showing some extra charts, a long-term historical chart of both the Midwest diesel price and the distillate inventories. And it just did come off a record low going back to how far you can track it. But you also see in this chart, Jesse, a pretty strong seasonal, which makes sense, where you build stocks for right now in the next 2 to 3 months. But then as you get into September, you draw those stocks down a lot. I'm guessing that's almost all agriculture, maybe some Christmas shipping by the truckers. But you see a very strong seasonal decline in stocks and a drawdown in stocks as you get past September. I want to get ahead of this. And so I went ahead and recommended to clients and subscribers today on the text blast to get their diesel needs locked in for harvest. The other wild card out there is what does happen with President Trump now pushing this extra tariff onto India. Do they buckle and buy more of our crude oil because our energy exports are really starting to take off? That was also in this week's numbers. So I think it might be time to look at that. Give me a call if you need some more questions answered individually.
Mike, great stuff as always. Anything final you would mention, reiterate for folks on the show today?
Yeah, the only thing I would say, Jesse, is what I've drawn a line in the sand is I'm gonna give the wheat and the corn a chance to move however they have to between now and the report. I don't want the beans to lose any more technical ground than they did on Wednesday's trade. That 960, 965 area is really important to hold because to me they're still very elevated. And I don't know if they need to be that elevated given what we're looking at in terms of future exports.
Folks want to talk with you, take a look at your analysis, have a conversation, and much more. What's the best way, Mike?
Best place is globalcomresearch.com, and that's globalcom with 2 M's, research.com, or give me a call on a toll-free number, which you can find on the website as well.
Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks for joining us again this week, and have a great one. We'll talk to you next week.
You too, Jesse. Thanks so much, sir.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.